Ladies and gentlemen, welcome back to the channel. I hope you guys are having a great day and your portfolios are looking a little bit on the green side today. The S&P 500 up over 2%, the Nasdaq up well over 2%. Now, exactly why is this happening? Well, the Michigan Consumer Sentiment Survey just came out, and that is definitely helping things, but also the Fed Bank stress test results were very, very positive for yesterday, and that's the difference between essentially a recession and a depression. If the banks cannot hold up and remain liquid, if you start to see bankruptcies, then you're in for a depression. We can kind of handle a recession as long as the banking system is healthy. That's kind of expected at this point. So that is a very bullish thing. The Michigan Consumer Sentiment Survey was also a very bullish thing, and we have been talking about this 5 to 10% rally from the bottom over the last couple of days, the last week or so. We're currently up over 6% from the bottom, so we did hit that on the head. We've made a lot of money based off of those statements, so hopefully you guys have as well. And I want to talk about where we are likely to go from here, not only in just the overall markets, but with AMC stock as well. So if you guys find value out of this video, hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you have an argument that is contrary to mine, even if we don't see eye to eye on that said topic, let me know your thoughts down below in the comment section. Thank you guys for doing that. If you guys want access to all of my trades in real time, we have been absolutely knocking it out of the park. Link down below in the pinned comment or in the description of this video. Prices will be going up here very, very shortly. And if you guys have not gotten your free stock, Webull, Moomoo, and Public, it is essentially free money. Deposit $100 and get yourself around 8 to 10 free stocks, depending if it is Moomoo or if it is Webull. So S&P 500 currently up 2.16%. Yes, indeed, it is a Friday as well. So as long as we can hold up this rally and even potentially rally into the close, that's going to be very, very bullish. Now, anything can happen. Let's be honest with each other. Anything can happen when it comes down to the markets. We could sell all of this off plus some by the end of the day. I don't expect that to happen, and it looks like the markets are probably going to rally into the close. Now take a look at this gap up that we've seen once pre-market trading did start. We essentially gapped up in a big way from about 377 all the way up to about 381. This is because the bank stress test results were a bullish thing, and markets really do like that, because like I said in the intro of this video, if the banks can't hold up, then nothing can hold up, and you're looking at a possible depression. You're looking at a lot of bad things, right? So that's why the markets initially gapped up, and then the markets gapped up right here because of Michigan consumer sentiment. That was very good as well. So let's first start off with the Fed Bank stress test and just go over what the stress test actually included and why that's such a big deal. So it says the Fed says banks can withstand 10% unemployment, 55% stock price drop in annual stress test. The Fed estimated $612 billion in potential losses for banks in its most severe economic scenario, and said even if this comes to pass, banks would still be healthy enough to provide loans to homes and businesses to keep the economy afloat. That's a $50 billion more severe loss projection than a year ago by the largest banks. The Fed's model included a 5.75% increase to unemployment to 10%, a 40% decline in commercial real estate prices, and a 55% drop in stock prices. And essentially what this is, long story short, all banks, they have to have a minimum of 4.5% of their assets under management in reserves. But ever since 2020, there has been an additional buffer on top of that. It was a long time ago. We covered this in 2021 because you had Goldman Sachs, you had JP Morgan, you had Bank of America. They had to put up like 7 to 10% additional reserves for that buffer zone, right? Now, depending on what each individual bank's risk portfolio looks like, or their risk management strategies, they're gonna again have to be reevaluated and potentially put up more or less money in that that cushion, right, on top of that 4.5% reserve ratio that they have to have for their assets under management. So this could be important as far as potentially causing even more margin calls, or the bank asking for some of their loans back, especially in their riskiest assets like some of the margin loans, right, so on and so forth. But this is seen as a bullish thing because every single bank, all 33 banks, passed their stress test. There was not one bank that actually went under during this economic scenario, and I'll take it for what it is. You know, it's bullish for the markets. I'm not necessarily 100% believing that all banks would be okay if that scenario actually played out, and they only estimate about $100 billion of potential trading and counterparty losses, as you guys can see right here. And the stress test also assumed more than 450 in loan losses. So I think the overall loss could be much more than 100 billion in the trading sector, given where margin is currently at, over 750 billion dollars. So I'm not so sure that that banks could handle this actual scenario in real life, but I don't know if that's actually going to happen in real life. It's probably not going to happen just like this. So it's a good thing. That's it. It's just a very good thing. But what really is causing us to rally as far as right now, it is the consumer sentiment survey followed by the Fed shows inflation expectations ease slightly. It says a widely followed consumer sentiment survey released Friday showed inflation expectations have eased slightly. The University of Michigan surveys of consumers said consumers expect inflation to rise at a 5.3% annualized rate as of the end of June. That's down from a preliminary reading released earlier this month, which showed inflation was expected by consumers to increase at a 5.4% clip. Still, surveys of consumers director Joanne Heshu said consumers, quote, also expressed the highest level of uncertainty over long-run inflation since 1991, continuing a sharp increase that began in 2021. It says Federal Reserve Chair Jerome Powell cited earlier this month an uptick in consumer inflation expectations helped sway the central bank to raise rates by 75 basis points. That's a bigger rate hike than many anticipated heading into the announcement. Meanwhile, the overall consumer sentiment fell to a record low, hitting 50. That's 14.4% below a May reading of 58.4% and a 41.5% from a year earlier period. Says consumers across income, age, education, geographic region, political affiliation, stock holding, and home ownership status all posted large declines. About 79% of consumers expected bad times in the year ahead for business conditions, the highest since 2009. Inflation continued to be a paramount concern of consumers. 47% of consumers blamed inflation for eroding their living standards, just 1 point shy of an all-time high last reached during the Great Recession. So it's good that the inflation expectations eased, because that's obviously something the Fed pays attention to, and it could mean the difference between the Fed going more aggressive or not as aggressive. Now, why I said in the beginning of this video, essentially, we're not done with the pain. The pain is not over. And why I specifically say that is because July 28th, we're probably going to be confirmed in a recession. That is when the advanced estimates for Q2 data, GDP data, do come out, and that's where we could get another negative reading, just like we got last quarter of a negative 1.5% reading. If we get a negative 0.1% reading or a negative 0.001% reading, just a very small, any negative reading, and you are in a technical recession, which I think a lot of people are in agreement that we're probably in a recession already. You're clearly seeing signs of a recession everywhere. The situation has definitely changed a lot over the past year, and that's when the markets really do freak out, when we go into a technical recession and the Fed continues to raise rates. Because if we do look at the Fed rate monitor tool, which I'm going to have to bring back up right here, it's very interesting, the dates. So let's take a look at it. So July 27th, the day before we get the GDP numbers, well, we're expected to get that 0.5% rate hike. The rates are expected to be in between 2.25% and 2.5%. Still very, very low, and still too low given where inflation is currently at. But then the next day after this Fed meeting, you're going to get the GDP result. So if the Fed raises rates, the next day we go into a technical recession. Well, let's just say it's not going to be a very bullish scenario. But we have 4 weeks, 5 days, 3 hours, and 4 minutes until the next Fed interest rate decision. So I do think the markets can likely trend to the upside as long as we don't get any more bad economic data until we do get the next Fed meeting, or at least until the week of the Fed meeting. That's where you tend to get more negativity overall. If we take a look at what we can expect for next week's data, one of the biggest data points is going to be ISM manufacturing PMI, but that does come out on Friday. Now on Thursday is really going to be the most important day in my personal opinion. You have your personal income month over month data, personal spending month over month, PCE price index month over month, initial jobless claims, core PCE price index month over month, and year over year. You have a lot of data that is coming out on Thursday. So Friday and Thursday, those are going to be the two most important days. And until then, I mean, you could, trend to the upside. Potentially Monday, Tuesday, and Wednesday. The biggest thing on Monday is durable goods orders, and that will probably move the markets around a lot, just considering, how sensitive the market is going to be to economic data. So that is that. Like I said, as far as the overall bounce from the bottom, I've been saying 5 to 10%. If we go from 362 to where we're currently sitting at 386.31, you're up about 6.3% from that low. To go up 10%, that's going to put us around 400 on the S&P 500. So that's likely what I expect to happen. That's getting close to this 404 level, which is where the 50-day moving average is. You'll probably come up to that 50-day moving average, find some resistance, and then come back down a little bit. The higher we go, the more those puts are potentially going to pay off down the line, for the July or for the August expiration. So I'm actually hoping for a good-sized bounce here, because you can make a lot more money shorting on the downside if the markets do bounce into a big fear catalyst or a big market event. So that is basically what is happening today. Nothing else. You don't have to go too far deep into it. I will say though, pay attention to the bond market. The bonds are going up today, which is good, because obviously maybe people are less fearful about a recession today than they were yesterday. But over the past couple of days, why you have seen bond yields actually come down so much is because bond investors are buying bonds, because people expect there to be a recession. If there is a recession, well, a 3.13% yield is not all too bad, because what do you get during recessions? Well, you get inflation that dramatically comes down, and you usually get deflation in one form or the other, and you don't even know, how much economic growth you're going to see or how well stocks will perform. So with all of that, all things considered, bond yields coming down means people are fearful of a recession. And short-term bond yields coming down, definitely going to be a good thing. Commodity prices coming down, definitely going to be a good thing. The price of oil has fallen a lot since where we were at, the 130s, 140s per barrel of oil, now sitting at 108. You've probably seen it reflected a little bit at the gas pumps, which is also a very good thing. So just watch the bond market. That will tell you a lot about how investors are feeling. The bond market is about 9 times larger than the stock market. So there is that. Let's talk about AMC, what is actually going on today. Ortex did change their interface just a little bit, so it's going to take a second to get used to, but the estimated short interest of free float is 22.51%. Free float out on loan, 37.15%. Shares out on loan, 191.48 million. Days to cover, 3.73. And then the cost to borrow is at 15.25%. 100% share utilization. And as you guys can see over here, this is actually really cool, something that they added from Interactive Brokers short share availability. They put this out, it looks like every 15 minutes, and the shares available are very low, 200 shares, 300 shares, but you're paying 18.5% to take out those shares and essentially short them into the markets. That's a lot, and that's very unsustainable if the stock price goes up or it does not come down in a big way. I don't think you're going to have a lot of long-term short positions actually coming out right here. It could be quick short-term positions, but I don't expect people to actually pay 18.5% to short AMC stock for a long duration of time. Now, the short shares that are available is 0, and that is why I do think there is not that many shares left to actually be sold short as of recently, right? I just don't think there's a lot of shares that are still available to be lent out, to be sold short. And what we can see from the option activity for the day is 2 orders. That is it so far, expiring July 22nd and July 15th. You have a $15 call and a $14 call. One of these worth about $26,500. The other one worth about $36,000, so about $50,000 give or take between the two. Those are the only interesting option activity that we could see for the day. 100% positive order value worth $62.6 thousand. So that is definitely a good sign, and I do think the overall markets are going to be controlled, and they're going to move, especially AMC stock, by the option activity more than anything else. So there is that. Stocko tracker data still looking very beautiful for the expiration of July 15th. 430,000 calls that are out of the money, 11,500 calls that are currently in the money, 90,000 puts that are in the money as well. So you're looking at potentially, I've said this before, but even if half of the amount of calls and puts went into the money, that's going to be about 25 million shares that market makers have to go out and buy. That is about the daily volume that you see as of recently on AMC stock. So that would obviously push the stock up in a very, very big way. So that is pretty much going to be all for this video. If you guys found value out of it, hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for tuning in. Get your free stock with Webull, Moomoo, and Public. And if you guys want to come trade with me live in real time, link down below in the pinned comment or in the description of this video. You guys enjoy the rest of your day, and I will see you in the next one.